All right, let's talk about taxes. But forget what you see on the forms for a minute. We're going to look at the tax system like a game, one with its own set of unwritten high-stakes rules. And honestly, understanding these rules is the key to playing the game well, whether you're filing for yourself or you're a tax professional.
So you think you know tax law? I mean, sure, we all know about deductions and deadlines, but the real game, that's played in the margins. It's played with the rules that define who's on the hook, what professionals can and can't do, and how money moves around the globe. We're about to pull back the curtain and see how the machine really works.
Okay, let's just dive right in. We're going to break down a few key areas where these hidden rules can have a huge impact. And first up is something that might surprise you: the incredible burden of proof that gets placed on the people who prepare our taxes. Right. So when you hire a tax preparer, you figure all the pressure is on you, the taxpayer. But the IRS has this really smart strategy that puts the preparer right in the hot seat. It all revolves around a little concept called due diligence, and let me tell you, it has some serious teeth. So think about it. If there's a mistake on a tax return, who does the IRS go after? The obvious answer seems to be the taxpayer, right? I mean, it's their name on the form. Well, this is where that first hidden rule really comes into play. Believe it or not, the IRS often goes straight for the tax preparer. They're not just looking at one client's return. They're auditing the preparer's entire process to make sure they followed every single rule to the letter. So you might be asking, why put so much heat on the professional? It comes down to this number right here. This is the penalty that the IRS can slap on a preparer for each time they fail to meet those due diligence requirements for certain tax benefits. We're talking about Section 6695G of the tax code, and that penalty, adjusted for inflation, is a cool $650 per mistake. And here is where things get really interesting. You see, that $650 penalty applies separately to 4 of the biggest tax benefits out there: the Earned Income Tax Credit, the Child Tax Credit, the American Opportunity Tax Credit, and the Head of Household Filing Status. So if a preparer messes up the due diligence on all 4 for just one client, well, you do the math. That's a potential $2,600 penalty on a single return. All of a sudden, focusing on the preparer makes a whole lot of financial sense for the IRS.
And this isn't some random process. It's incredibly methodical. It usually kicks off with the IRS asking for around 25 client files. Then an agent goes through everything: the preparer's notes, their checklists, the questionnaires they had clients fill out, looking for proof they asked all the right questions. And the final step? A phone interview where the agent drills down on their entire process. It's a full-blown examination of their professional competence. So, knowing the kind of pressure that tax preparers are under, how can you, as the taxpayer, actually use IRS resources to your advantage? How can you spot the difference between a real pro and a real problem? Let's get into it. Okay, this is so important. These are the red flags to watch out for. A legit preparer always signs the return and puts their preparer tax ID number, their PTIN, on it. A fraudulent ghost preparer won't. They'll ask you to sign it and leave their spot blank. They might promise you a massive refund, often for a cash fee that's a percentage of that refund. And then, poof, they're gone after tax season. A real pro, because they're doing their due diligence, asks a ton of questions. A ghost preparer, they barely ask for anything. And here's another one of those subtle but super critical rule changes, especially for anyone in the gig economy. The IRS is slowly rolling out that new, lower $600 reporting threshold for platforms like PayPal or Venmo. But, and this is key, it's not happening all at once. For the 2024 tax year, the trigger is actually $5,000. It's like they're slowly tightening the net, and you really need to be aware of how it's being phased in. Now, the most important takeaway here is that you're not just guessing. The IRS itself gives you a free tool, a searchable online database of preparers who have actual professional credentials. You can look someone up and verify that they are who they say they are. Think of it as your first and best line of defense against those ghost preparers.
Okay, moving on to our third area. For anybody with financial ties outside the US, the rules get way more complex and the penalties get even steeper. So let's look at a couple of major tripwires in the world of international tax. This one is huge. The foreign tax credit is a great tool. It's designed to make sure you're not taxed twice on the same income. But there's a really big catch. You can only claim a credit for taxes you were legally forced to pay to another country. If you just make a mistake and overpay them, the IRS says, sorry, that's not our problem. They won't let you use that overpayment to lower your US tax bill. You have to go back to that foreign country and ask for your money back. Now this slide shows a fascinating cause and effect with consequences that last forever. If you're a green card holder and you work for a foreign government, like at an embassy, you have a really tough choice. To keep your green card, you have to give up any diplomatic immunity you might have. You do that by signing this one form, Form I-508. The second you sign it, you permanently lose the tax exemption on your salary. It's a single signature on an immigration form that triggers an irreversible tax outcome. Wild, right? And for our last piece, let's look at the ethical rulebook that all tax pros have to live by. It's called Circular 230, and these rules aren't just polite suggestions. They are the enforceable standards of their profession, and they have a direct impact on you, the client. So here's the classic problem. A tax pro does all the work, but the client doesn't pay their bill. The pro is sitting there with all the client's original documents. It seems like fair leverage to just hold on to them until they get paid, right? But what does the rulebook say? The rulebook could not be more clear. Absolutely not. A practitioner's duty to help a client meet their tax obligations is more important than any fee dispute. Basically, holding records hostage is a major violation of Circular 230 and can get them into serious trouble. Okay, what about this one? A preparer is looking at an old return and finds a huge error, one that could cost the client or the government a lot of money. The natural impulse is just to fix it, but can they? And again, the rule here is subtle but super clear. The practitioner has a duty to tell the client about the mistake and what it means, but they absolutely cannot take any action without the client's direct permission. Just going ahead and filing an amended return would violate their duty of confidentiality and could even open them up to a malpractice lawsuit. So, let's pull all this together. The tax system isn't just about plugging numbers into forms. It's this complex web of professional pressures, tricky international rules, and really strict ethical lines. Understanding these deeper mechanics, well, that's what separates someone just going through the motions from someone who's truly a savvy navigator. So, the question I'll leave you with is, now that you know some of the hidden rules, how will you play the game differently?